Trump's nightmare scenario just arrived, and the shocking bombshell could spell disaster for him. Here's what you need to know. I'm your host, Steve Van Metre, and thanks for joining me today. In our show today, a nightmare scenario just hit the White House, and it could pit Trump against the Federal Reserve in an all-out battle to prevent a recession and a banking crisis. The stakes, as you're about to see, have never been higher. Now let's head over to Bloomberg, where we picked today's story with a headline: as regional banks face headache from rising Treasury yields, and we know investors want to drive interest rates higher. They want to see the 10-year up around 5%. And what the problem they don't realize is the banking system is in a very fragile state and could come unwound in a major way. This, for the Trump administration, would be a major nightmare, causing an all-out battle to drive interest rates lower. Rising long-term yields certainly leave the banking system more fragile in the short run. Well, it's longer than that, because here's the issue. Back during the pandemic, the banks took on a lot of debt in terms of Treasury bonds that they borrowed. The issue is rates went higher, and a lot higher after that, meaning the banks are upside down on these bonds. If they try to sell them, they take a massive loss. The problem for banks are when they need cash, when the economy slows and there's a demand for money, they don't have the cash. So what they normally do is sell their very liquid Treasury holdings to raise it. But throughout history, there have been rare times where the banks have faced unrealized losses, and never at the magnitude they have now. And based on what's coming, based on what you're about to see, it's telling us the banks are in a precarious situation, one that could lead to an all-out crisis. In a normal economic scenario, higher yields are more profitable, but we're far from that. A surge in 10-year yields last year likely reversed most of the decline in unrealized losses on banks available for sale and held to maturity in the third quarter. This from FDIC chairman. Now, this is highly unlikely. We go back to the pandemic, March of 2020. Where are we right now? We're in the early part of 2025. We're not even 5 years out. The banks took on and bought long-term debt. They didn't buy, 2, 3, and 5 year debt only. They went out and bought 7, 10, 20, and 30-year bonds. They're massively upside down on this. And if you think back, why did the Fed come out with the bank term funding program when the banks needed cash? It was simple: to swap those illiquid Treasury securities, normal conditions, which they were sold on the market to raise cash. They sold it instead to the Fed to get the cash they needed. That's how bad the system is right now. So anything that we could face right now, either an economic downturn or something that hits the banks, could push them into massive insolvencies and cause hundreds, as you're about to see, to fail. If borrowing benchmarks remain high, regional banks risk higher losses on commercial real estate because borrowers will struggle to refinance. Estimates show about 14% of the $3 trillion U.S. commercial real estate loans are underwater, rising to 44% for offices. So you can see the damage higher interest rates are doing on the banks. They're already upside down on their assets. That is the Treasury securities. But their other asset, their loan book in the commercial real estate space, they're upside down on. So if the U.S. economy were to slow from here, it's a dangerous place for the banks. They're not only going to face liquidity issues, as there'll be a demand for cash that they can't meet, but what you're about to see is there's going to be a rash of bank failures that could be in the hundreds. Now, I want to know from you, are you concerned about banks failing again? Weigh in the comments. Let's get this lit on fire. I want to know what you think. Weigh in the comments below, because the number of banks at risk of insolvency rises with the yields as they go up. And remember, Wall Street wants to see 10-year Treasury yields at 5%. What they're not telling you is it's going to lead to a wave of bank failures. And of course, that means rates will come right back down. But let's take a look here at this chart. As we can see, when there's no commercial real estate stress due to higher yields, you're already facing around 50 bank failures. You throw in a distress rate of 10%, you're now up to 75 banks. You get to 20% or more, you're looking at over 100 banks failing, and that's just the beginning of what we could see facing Trump and this next administration. It's going to be a major issue that's going to put him head to head against the Fed, because he's going to demand rates go down. The problem is short-term rates have gone down, but long-term rates have actually gone back up. This is a problem because the Fed doesn't control the long end of the curve. And if we start to see banks failing under Trump's second term, you can see this would be an outright nightmare scenario for him. But one thing that should be surging higher is your trading account right alongside mine, which is breaking out today. Here's a trade that went out to our subscribers. I'm not telling you what it is. If you want to know, you got to hit the links in the description below. Use a coupon code for that 30-day free trial. Right now, look at this. That trade went on the books late December, up 6.4% relative to the market, down 0.32%. Our Momentum Timer Pro subscribers picked it up a couple days earlier. They've got a lead as well. Now, what are these reports and what do we do every day? It's simple. We look at machine position. This is called our CTA Timer Pro, and machines buy massive amounts of money. So what we do is position our subscribers to buy in front of the machines and sell before they get out. Now, maybe you like to trade those technical signals like the RSI and the MACD, but you struggle. You get in late, you get out early, you're all over the place. Well, we smooth it out with a proprietary overlay. We call that Momentum Timer Pro, and I trade my own reports. In fact, I disclose what my trading is to all my subscribers. You could trade right alongside me as I'm breaking out today against the market, and you could too. You get the reports, you get the signals. I go through and give you my opinions on which trades I think you should take. We back test our reports so we know they work. We give you risk control levels, a full tracking of trades in return, and a weekend update on our entire trade book. And you can grab that 30-day free trial right now. Use the links in the description below because I'm crushing the market. And right now, you could be joining me with that as my trades break out to the upside. But something that's going to break apart, that's the office market, which is yet to stabilize, which is why I remain concerned and remained well reserved. This from PNC Financial. The bank increased the reserves it set aside to cover soured office loans by 13.3%, up from 8.7% at the end of 2023. Although it's only a small proportion of their overall book, it's the trend here that matters. So what happens with banks is when they face it, they're going to see loans go into default or insolvency or delinquency. They have to set money aside to cover those losses. Now, the problem is that money that's going into their loss book means they're not lending. And we've already heard President Trump say on the campaign trail, he needs banks to lend, he needs the economy to turn around, and in a debt-based economy, you need the banks to lend. This is very critical to the success of a second administration. And the problem is we're facing a banking system, particularly in the regional banks, that are upside down on their assets, including those commercial real estate loans. If you want to understand why there's going to be a massive push to get people back into the office, well, you're going to see why, because the banking system needs them back, and in a big way. Let's take a look at the impact that higher interest rates have on a slowing economy and what it means to lending. As we take a look at the weekly commercial industrial lending data, that's shown in blue on a year-over-year rate of change against 10-year Treasury yields, that in red. Here you can see around 2004 into 2005, yields in red are rising, and that starts to slow down the rate of commercial industrial lending that shoots a little bit higher going into the global financial crisis, and then comes crumbling down as yields go down with it. So what we can see is there is a supply and demand component for loans. So when rates get too high and people can't afford it, or they don't see the opportunity to borrow and invest that money back into the real economy to make a yield, they don't do it. And that's a problem here because, again, the market wants rates to go higher. The lending business says there's no demand. Now, we take a look at around 2017, what happens? We see rates going higher as Trump's into his first term, and that eventually causes the commercial lending market to slow down. It rolls over, and next thing you know, yields are crashing down with it. This time, what do we see? Rates are going up. Market participants, they want them to go even higher, but the year-over-year rate of change is just over the 0% line, and what it suggests is there is not demand at the current level to offset all the loans that are being paid down and paid off. And this is a problem because, again, if you want to see the economy expand, you need the banks to lend. We're not seeing that happen at current rates. Still, with borrowing benchmarks trending up, even as the Fed cuts interest rates, we're entering a very precarious position. Instead of escaping this area of bank fragility, we're moving toward an increasing area of bank fragility, which means not only do rates come down, they need to see long-term rates come down. And this is going to, again, put President Trump right head-to-head with Fed Chair Jerome Powell. We know he doesn't have control of the long end of the curve. It's dangerous because right now the last thing consumers want to see is bank failures. It could cause all-out panic and actually have a major impact on Trump's second term. Could be the nightmare scenario he doesn't want to face. But now Trump's tariff threats are escalating, and they could be the tipping point that sends the U.S. economy spiraling. But is it already too late to prevent a crash? As Trump's plans to impose 25% tariffs on Mexico and Canada now slated for February 1st. Tariffs of the magnitude Trump is proposing on U.S. neighbors would cripple U.S. car makers. This is a dangerous problem, as we're already seeing issues in the U.S. manufacturing sector as jobs are going away. We're seeing hours work get cut, and pay increases are increasingly getting smaller. Stellantis imports about 40% of the vehicles they sell in the U.S., while General Motors imports roughly 30% and Ford 25%. The additional levies would hit about $97 billion worth of auto parts and 4 million finished vehicles that come into the U.S. from those countries, and could boost the average new car price by about $3,000. And this is a problem because what are we seeing right now? Consumers can't afford higher prices. And as they spend less on automobiles, particularly because demand for autos is going away, what are we seeing with baby boomers? They're retiring. They're scaling back the number of vehicles they need. They're driving their vehicles longer. What are we seeing as people work from home? They're driving less. And so now you're going to understand why there's going to be a massive push from the government to get people back into the office, not just because the banks are sitting on all these upside down office loans, but because the car manufacturers are going to need people to buy. And let's take a look at the auto inventory to sales ratio against the net percentage of domestic banks tightening standards for auto loans. That's shown in red. And what we can see is going into recessions, we note there is one very clear trend, is that auto inventories rise relative to sales. And now look what we're seeing since 2022. Inventories have been rising and sales have been slowing. And look what the banks did in 2022. They started tightening standards for people who wanted to borrow for car loans. Now going forward into 2023 and into 2024, they slowed the pace of tightening, but still they're making it more difficult for buyers to get a new car. And for U.S. workers, this is not a sign that they want. And again, for Trump, to put him at odds with many corporate CEOs. As we take a look at the auto inventory to sales ratio, still in blue, against continued unemployment claims in red. And what do we see when inventories rise relative to sales? Well, people get on the unemployment line and stay there until the trend reverses. We see that happen again in 2000. At the same time, continued claims bottom. We see inventory levels in the automobile industry rising. How about around 2006? We start to get a picture that people aren't buying as many cars. Inventories are starting to build up on dealer lots. And what does that mean? Manufacturing workers hit the unemployment line, stay there, and as their purchasing power goes away, continued claims rise as we head right into a global financial crisis. And look at this, in 2022, inventory levels bottom out and start to rise. Shortly thereafter, continued claims head higher. And again, one of the most important things for Trump right now is getting U.S. manufacturing to turn around. If we put tariffs on and that causes vehicle prices to go up by about $3,000, it's going to mean demand is going to plunge even more. But something I want to know from you, let's light up the comments. Are you pro-tariff or against tariffs? Where are you at on that? Let me know. I'd love to see what you think, because in turn, the Mexican peso tumbled after President Donald Trump vowed to impose strict tariffs, reigniting fears among traders that the nation will become a target over the next 4 years. The currency weakened as much as 1.4% before trimming losses. The sell-off, the worst in emerging markets, came a day after Trump said he slapped tariffs on as much as 25% on Mexico and Canada. We know that's coming potentially on February 1st. Now, what does this mean in the currency markets? It means they understand that trade is going to go down, and in a big way, and demand for their currencies is going to go down. So you think about the automobile industry, what does that mean? If demand is going down, it means inventory levels are going to rise. It means that manufacturers are going to need fewer workers. It's going to backfeed into the U.S. economy into a dangerous way. But is it too late for the U.S. economy? Well, based on what we're seeing from Apple and what we might see next week, there's a good indication it's already too late. And Apple's tough January worsens as analysts cut on iPhone risk. And shares fell 3.2% on Tuesday, extending what had been a rocky start for the year for the world's largest company by market cap. The stock is down 11% in January, putting it on track for its biggest one-month decline since December of 2022. It's dropped almost 14% from its December peak. And analysts are saying that weakness in the iPhone sales have been worse than expected, with the China market a particular concern, and no surprise, because what are we seeing in China? We're seeing their economy head into recession, and we're seeing, of course, the workers there have less money to spend on the discretionary economy, and so they are spending less because they're not seeing when they go to work a turnaround in the global economy. So they're starting to believe that things are getting worse, and sure enough, for Apple, that is not a good sign. Independent research indicates that iPhone sales sunk a whopping 18.2% in China during the December quarter, while global unit sales fell about 5% in the final quarter of last year. In citing third-party survey, Lee added that consumers do not yet find smartphone AI useful and, quote, is unlikely to kickstart a super upgrade cycle anytime soon. In fact, Microsoft recently came out and said that people aren't using AI to the extent that they expected, meaning they're going to have to spend money on advertising to educate consumers. So keep in mind, these companies spent hundreds of billions of dollars on AI. Investors came in and said, yes, this is going to cause a surge of demand. What we're seeing from Apple and from Microsoft is it's not there, meaning the market also overvalued another nightmare scenario from Trump if we start to see stocks sell off. But we knew this was likely the case because when we take a look at real retail sales, that's adjusted for inflation, shown in blue, against average hourly earnings of production and non-supervisory employees, that in red, both on a year-over-year rate of change, what we can see is periods where you see a decline in average hourly earnings. That's where the red line is headed lower. Well, it directly impacts what workers can spend. Retail sales go down. You see going around 2006, the two start to get more in line as retail sales were already slowing. We see wage growth peaking against rising inflation. And then as wage growth slows, retail sales plunge. And how about now? We look to 2022, we see a peak in earnings, and that has come down and is dropping rapidly. Real retail sales have only shown about a positive trend a few months out of the last 3 years. What it tells us is demand from U.S. consumers is outright plunging. They don't have the money to afford all this new tech. And again, keep in mind, investors bought big in the equity market on this. Companies invested big. The problem is consumers just don't have the money, which means Trump could face a second nightmare scenario here. That is a plunging stock market. And we'll hear from Apple next week, but Trump's tariff shifts are a warning for corporate America to expect whiplash. The problem is for corporate America, they might be excited about the tariffs now, but when they realize that sales are plunging and consumers can't afford higher prices, well, that could change very quickly. And the apparent changes in Trump's tariff stand over the course of about 12 hours underscores the enormity of the challenge now facing business leaders in the U.S. and around the world. And perhaps they're telling Trump, hey, we thought business was going to boom after the election, but turns out it didn't. We need you to hold off. So again, Trump is facing an all-out battle with the Fed over the banking system and perhaps with CEOs over tariffs. And all we know is that things are setting up big here. If something goes wrong with the banking system, all bets are off. He's going to have a massive crisis on his hand, one that may be too big to stop. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.